Hello, everyone. Today on the final bar, my guest is Craig Johnson from Piper Sandler, coming to us from Minneapolis. Today on Fed Day, a lot of sort of treading water, pausing and holding our breath until the Fed results of the Fed meeting, Powell's comments this afternoon. Overall, the market moving pretty quickly afterwards, with stocks certainly moving higher, but not materially higher, right? A little bit above where they're at. Gold on the move, interest rates fluctuating, everything volatile on Fed Day. Let's look at all of those charts together. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Eastern Washington this week. Thanks for joining us every weekday after the close as we break down the market activity together using the power of stock charts, using data visualization, technical analysis, investor behavior, all of those things we can do to try to make sense of a market in uncertain times. Plenty of volatility just in general in recent weeks and recent months, but especially on a day like today, Fed Day, when you have comments from the Fed that tend to move things very quickly. And coming up with my guest, Craig Johnson, we'll have a discussion about some of the big picture themes, how assets like stocks and bonds and oil and others have evolved over time, and what a day like today means in the context of the longer term trends. Now, as I mentioned, Craig Johnson coming up today, who's a fantastic technical analyst and strategist. We have more great guests coming our way in future days and weeks. Tomorrow on the 18th, we have Tony Dwyer from Canaccord Genuity and Dwyer Strategy. Next week on Tuesday, the 23rd, we have Mark Newton from Newton Advisors. And then on Wednesday, March 24th, Samantha Leduc from Leduc Trading joining the show. Also, as a reminder, we just went live with our homepage for the upcoming Chart Madness special. Go to stockcharts.com/chartmadness. You can see what is going to be happening on Monday. 4 of us will be picking our brackets. We have a group of 16 stocks we threw in a bracket. We'll be debating the strengths and weaknesses of each name based on the charts, and in the end, pick our final 4, our proposed champions, thinking about these stocks for the next 6 months and where the opportunities may lie. You can download your own bracket, fill it out, see how your picks match up with ours, and we can follow the stocks along in the coming months and see what actually plays out relative to our expectations. Go to stockcharts.com/chartmadness and join us on the 22nd. It runs at 5 p.m. Eastern on StockCharts TV. Let's continue on with our market recap. As I mentioned, Fed Day, so a lot of things in flux. A number of interviews earlier today with media outlets talking about Fed days and what they tend to mean. And in general, the general playbook for a Fed Day is earlier in the day tends to be sort of a quiet period as you prepare for what's going to come. Usually not a ton of movements. But there were certainly stocks like home builders come to mind that were jumping pretty good before the announcement. But in general, you tend to have kind of a quiet period afterwards, tend to be some quick, sudden movements. But in the end, right, it's all about what has materially changed, what has really evolved. And I think we think about Fed Day and we focus on it because there tends to be a lot of volatility. And certainly we've seen an injection of volatility in the second half of the day. If you look at the chart of the S&P, it's sort of one market in the first half of the day, then after 2 p.m., it turns into a very different look. But in the end, it's where we at, very different. And what I didn't hear was anything incredibly different from what we've seen up until now. It sort of gives you the expectation that you see continued trends that we have seen, continuing to see things like industrials and materials and others that have been doing well appear to be continuing to do well going forward. 10-year yields spiked pretty good, but came off in the afternoon, settled back down to let's see, about 164. It looks like. We'll see what where the closing tick sort of played out. Looking at stocks in particular, the S&P closed up about 1/3%, just under that, around 3974. Mid caps and small caps up even more. So it was a certainly offense over defense, broadly speaking. If you look at market caps in the VIX, back down around 19 actually, which is incredibly low. Hasn't been below 20 in a long time. May not have been this year actually. Yields, as I mentioned, coming off there in the afternoon, and but overall higher for the day. Bond prices lower with the TLT around 135.30 and the dollar down about 0.5% today. Looking at other asset classes, gold, silver really spiked in the afternoon. And generally you think of gold as an inflation hedge. So inflation concerns would usually mean gold prices go higher as a hedge for that. And you certainly saw that spike with gold and silver. Also industrial metals like copper coming up at the end of the day. Cryptocurrencies in general really appreciated toward the end of the day, with Bitcoin closing around 58,000 today. Let's look at a chart of the S&P 500 and just talk about the big picture scenario. So once again, today we have a new all-time high intraday and a new all-time closing high, with the S&P rallying today, closing around 3974. So we're very, very close to that 4,000 level. And it's funny, I'm reading a book, as I mentioned a couple times in recent weeks, the book Bull by Maggie Mahar, which is all about 1982 to 2004 and sort of that bull market phase in the 80s and 90s, and then the tech bubble and how it rolled over. Really focuses on market strategists, people like Gil Dudek and Ralph Acampora and Richard Russell and others that were speculating on what was happening from a technical perspective. And it's interesting to think about that scenario relative to what we've seen now, because you look at the levels of the different asset classes we were talking about, and S&P 4,000 would have been ridiculous. This is when they were talking about Dow 10,000, and that seemed insane. So certainly we've made plenty of progress since then. Big round numbers don't concern me as much about the trend and what I'm seeing continually from the chart of the S&P. If you take a step back and just look at the overall trajectory of the market, higher highs and higher lows, that's a thumbs up. What makes me concerned about the fact that we keep making higher highs, it's because the momentum is lessening and lessening. Every time we make a new high, it appears to be on lower momentum. I think that has to change at some point, right? Either the price comes off and recognizes the waning momentum, the lack of buying power that's pushing things higher, or the momentum really increases. You have a new wave of buyers that pushes things to new highs. What concerns me is about the euphoric sentiment readings that we've had. Anecdotally, who is left with to push the price higher? What buyers have not bought in yet that would be pushing the price to new highs? That's, I think, the open question. What makes me think overall is there limited upside but potential for downside, and is that how we should be thinking about the markets right now? But in general, focus on the trends as always, and let's focus on the themes that actually emerge. Looking at sectors and what movements we had today, with the S&P up about 0.3%. You had consumer discretionary, industrials, energy materials really leading the way higher. On the downside, utilities, the worst of the 11, down 1.5%. These fluctuated quite a bit in the afternoon, and technology essentially finished the day flat. Tech and communication services, which have been a little lower on the list, sort of finished the day sort of mid-range. Things to pay attention to today from a technical perspective, charts like Viacom and Discovery, which I mention a lot only because they're the top ranked stocks in our scooter rankings, right? So if you look at the large cap scooter rankings, this percentile ranks the entire large cap universe from strongest to weakness based on a proprietary mix of trend characteristics, which you can find in our chart school section of the website. But some of those big names names that have been at the top of that list came off pretty good today. So Viacom actually down 4% today. And again, that is still coming off of crazy highs just a couple of days ago. What's really interesting to me from a technical perspective on the chart of Viacom, number one, as it pulls back, the question is, where's support? And the problem is it's had such a run. When you have a stock that has had such an exponential rise like this, when you pull back, you really don't have any clean support levels very close to where we're at, right? A volatile run on the way up usually means a volatile pullback sort of period. There's not really a lot to look at on this chart. The closest thing I would say would be around 60, which would be the low from February. That was the last pullback before the big move higher. And that's also right where the 50-day moving averages. So remaining above there would be great. The problem is that's about 30% below where we're at right now. The other one that's interesting on this chart in particular is the fact that we just hit $100 a share. And there is plenty of work that has been done on big round numbers and how stocks tend to find support and resistance at big round numbers. I would argue that a lot of that is investors stepping back and thinking, is this a triple digit stock or not? And just psychologically, when it changes that first digit and adds a digit to the price, it makes you rethink things and rethink whether it's worth that valuation. When it's above and comes down to it, you wonder whether it's a single digit stock. So I think it's very interesting to see it pulled back from 100. That's actually very reasonable. If it would regain that, close above 100, that would indicate certainly increased momentum to the upside. You also saw some good movement from home builders today. So Lennar was the biggest gainer in the scooter rankings today. So the one that changed its ranking the most to the upside. Lennar up almost 14% today. So still 74th percentile. It's not the strongest trend anywhere, but the home builders as a whole actually look fairly decent, right? You've had this, the pullback to the March low, recovered those a little earlier than other stocks around July or August. Lennar made a new high. Then I had sort of this dead period here in November, December, where you can see the relative strength was struggling as these stocks actually held their ground while other things were rotating out. This is when things like financials and others really accelerating to the upside starting in November. And then from there, you've seen it chop around, pull back to the 50 down, now resolve in a big way back to the upside, making a new 12-month plus relative high, which is impressive. So Lennar is the name at the top of the list. The ITB is the ETF that comes to mind, up about 4% with nice, decent trend characteristics coming off of the 50-day. XHB is the other one, but that includes a bunch of other kind of home builder like things like Home Depot and others are in that one. But maybe worth a look if you've missed those, making new 52-week highs today. We need to take a quick commercial break. We'll be back with Craig Johnson from Piper Sandler. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close as we break down the technical themes and movements of the day. As a reminder, we would love to hear from you, particularly questions that come up in your own process as you're analyzing your charts. Questions on particular tickers, technical indicators, market history, whatever it is, we'd love to help point you in the right direction. Shoot us an email, thefinalbar@StockCharts.com, on Twitter @FinalBarSCTV. On our YouTube channel, just put a comment right below the video that you're watching. We'd love to answer one of your questions in our next mailbag segment on Friday's show. Also, as a reminder, the new StockCharts TV on demand is ready for you. Go to StockChartsTV.com, use your email, set up a free account. You can look at all the great content, our fantastic hosts, all the wonderful guests we have coming through our different shows, all on there on demand that you can watch from the website, also from all of your mobile devices. So look us up on any of the app stores, StockCharts TV on demand. I want to welcome on my guest, Craig Johnson from Piper Sandler. Craig's been on this show before. I've followed Craig and his work for many, many years. We've enjoyed working together on things like the CMT Association. Craig, pleasure to have you back on.
Dave, thanks for having me back. And this is a very interesting market, and I think it's certainly a market that we've got to pay a lot of attention to at this point in time, Dave. And
so it's a challenging period, especially on a Fed day. And I think a lot of people get very sucked into the short-term movements. I appreciate that you're bringing up some charts that help us think a little more long-term about what today means within the context of the big picture. We're starting with the S&P. What are you seeing overall with equities?
So Dave, I think the biggest risk we've got is overthinking this market. And I think I fit into that category myself too. But if you take and you look at this particular chart and you actually start to draw a channel, kind of starting at these November lows, and then you just kind of draw a nice little channel all the way up. This has been a market that's been inside of this upward trending channel since we started to break out above those highs we had back in the November timeframe. And it's been a pretty consistent price channel as you've been starting to move up from here. And I think the way we need to think about this is, as long as we stay in this kind of upward trending price channel, I think we should not think about overthinking this market at this point in time. We're still making higher highs. Like you said, we've got an upward sloping 50-day, upward sloping 200-day moving average. Even though we've got some divergences in terms of the momentum at this point in time, I've got over 90% of our groups inside of the Piper Sandler work, Dave, that still remain above their rising 40-week moving averages. I still have more of our groups, and we got 406 groups that are making 26-week new highs at this point in time. Very few that are making new lows. We should be encouraged by the breadth that we see. And, I think maybe the challenge is that we've gone back and we've looked at history so much that when we see these kind of readings, you look at them and say, well, they really shouldn't be sustainable for extended periods of time. And when we first got into these readings, Dave, back in the early part of September of last year, we saw that kind of peak up. We got this correction. We then rebounded after you came back and you retested the prior highs you'd seen back in the kind of June timeframe. And then we tried to rally back up, bake people out by putting in a lower high back there in mid-October. And then we corrected again back to support. And then we took off and haven't looked back since. But again, Dave, I look at this market and say, I think the biggest risk we've got is trying to overthink this. And again, we've got the twin towers of not only fiscal stimulus, but monetary stimulus. And we heard from the Fed today, which will get us to our second chart looking at 10-year bond yields, which is the Fed has pretty much said that they're going to remain accommodative till 2023. So they're going to keep the short end of the curve anchored. And then we're going to continue to see inflation expectations building. And the Fed has said they don't see that inflation is of any sort of concern at this point in time. They think it's sort of ordinary right now and more transitory than it is long lasting. But the bond market initially we basically started out where we closed at 1.62 on the 10-year bond yield, traded as high as about 1.69 intraday. And now we're back to that sort of 1.62-ish range here at the close. From my perspective, I still continue to think rates are going to move higher. We've been looking for rates to be toward, 150, maybe 175 by year end. I think that may prove to be too low as seeing rates move back up to 2% very easily could be doable in coming months and in coming quarters, given the Fed's mandate to keep rates low for an extended period of time. So, Dave, I would think that that's going to continue to benefit the financial sectors. I think that's also going to continue to benefit perhaps some of the commodities too. And that's the other chart that I wanted to bring up, which was looking at crude prices. So if we step back and look at a little bit of a longer term crude oil price, what's interesting to me is that when you go back and you look at that October sort of 18 high, we've just started the reverse. Right there, Dave. We started looking at that and you just draw a line right through there and you'll see that we started to reverse the long-term sort of multi-year downtrend for crude oil prices. And from my perspective, we could see a move back up to the mid 70s or maybe even higher. And when I look at some point and figure charts, I've actually seen numbers on the continuous crude contract that could get you closer to $100 a barrel oil, which I think would be very interesting as you look forward over the next, say, 6 to 12 months from here. So overall, Dave, I think the market's moving in the right direction. I think we're starting to see the signs of inflation building, but they're not enough to sort of slow down the recovery at this point in time. So I think as technicians, we got to try to avoid overthinking this market and really stick with the longer term trend. And that longer term trend right now is still up. Even though we're getting close to our year-end objective of 42.25, less than about 6% or so to go from this perspective. I think the trend is still up and we still have to play it from the upside.
I love that recommendation. I hope everyone, if they take nothing else away from your comments, Greg, is not to overthink things. And you're absolutely right. The trend in stocks has been higher. Trend in oil has been healthy. Trend in rates has been higher. There's no reason why we can't continue in those moves until proven otherwise. Craig, awesome to have you on the show. Thanks as always for sharing some of your thoughts and your perspective with us. Stay safe. We'll talk to you again soon.
Thank you.
That's Craig Johnson. Craig's the chief technical strategist at Piper Sandler in Minneapolis. I've again known Craig and have followed his work for a number of years and enjoyed. He mentioned the groups and what percent were above their moving averages. That's called the micro group system, which is something that Craig and his predecessor at Piper Jaffray, now Piper Sandler, developed and enjoyed. When I was on the institutional side, following Craig's work with the microgroups, does a really good job of illustrating some of that breadth. And I think his comments on breadth line up pretty well with some of the things we've been talking about, where you see breadth has been positive. Cumulative advanced decline lines are not going down, and they're certainly not diverging. They're making new highs, just like stocks are. So until that changes, it's hard to be anything but fairly encouraged by some of the signs that we're seeing. We need to continue on. Our next segment is called the Mindful Investor. We love to do occasionally is just take a step back and focus on some part of the technical toolkit, focusing on routines and discipline. What I want to talk about today was in particular the Hindenburg Omen. And the reason why I wanted to do that is because I've gotten a number of questions about this. There's some buzz recently when some of the signs of the Hindenburg Omen flared up. I had some follow-up questions on a couple different places asking about what exactly that meant. So I thought I would dive a little deeper into the construction of this indicator, what it means, and how it actually works. Now, why is this in a segment called the Mindful Investor? So for me, a mindful investor does a couple things. They focus on their past. They focus on making, learning from their mistakes and successes in the past. They focus on the future, so they develop a good game plan to minimize guesswork and have a good sense of where things are headed next. But then most importantly, they have a good market awareness, and that's why I think this fits in. It's all about seeing what is happening around you, focusing on what is happening around you as an investor. And I always compare it to flying an airplane. When you're flying, you always want to have a sense of where you're at relative to the ground, relative to your map, relative to obstacles, other aircraft, all of that. And as investors, we don't pay enough attention of where we're at relative to our surroundings. So hopefully this helps give you a sense of what the Hindenburg Omen is and how we actually use it. I'm showing here the components of the Hindenburg Omen. Forget about the purple lines here for a minute, but below here we have, let's see, three components really to it. Number one is you're looking at new highs and new lows. And the idea is you need at least 2.8% of new highs and 2.8% of new lows. And what I mean is if you take the number of 52-week highs versus the total issues that are traded, you need that 52-week high number to be at least 2.8%. On the same thing on the downside, you need the new lows to be at least 2.8%. What I'm doing here is showing the new highs in green, showing the new lows in red. So basically when both of these lines are visible and getting away from the zero line, that's when that item is triggered. So what this means is there's indecision. It's not just a bunch of stocks blowing off and making new highs. It's not a bunch of stocks making new lows. It's both, right? So you have stocks making new highs and new lows, which is actually unusual. And for the creator of this, Jim Yeka, it represented indecision. Number two is you're looking at the rate of change of the New York Composite Index. That's $NYA. I'm doing a 50-day rate of change, and essentially this needs to be above zero. That would be the second item. The third item that would happen would be the McClellan oscillator goes back below zero. And when those three happen, that triggers the sell signal. Now, this is a simplification. There are a lot of different versions of this, and if you read different articles, I'd encourage you to read our Chart School article on the Hindenburg Omen. You'll see some different things about it, but essentially has some variation of these. I've seen some variations that say the new highs can't be more than two times the number of new lows, and some of the percentages may be a little different, but that is the general sense of it. What this tells you is the rate of change of the New York Composite Index tells you the market is in a long-term uptrend. The new highs and new lows both increasing essentially means you have indecision because you have stocks going up and down. And then finally, the McClellan oscillator goes below zero, which tells you the advanced decliners are turning more negative. So what we have done is we have created a set of indicators. Exclamation point BINYHOD is basically the Hindenburg Omen on the New York Stock Exchange. And this actually goes from 0 to +3, depending on if each of those three items are giving a thumbs up or a thumbs down in terms of qualifying for the Hindenburg Omen items. And what that means is essentially, we simplified a little bit. We basically say 52-week highs and 52-week lows, at least 2.5% of total issues. Number two, the 50-day moving average of the New York Composite Index is that positive. And number three, does the McClellan oscillator turn negative? What you'll notice is it's not just when that happens one day that is super meaningful. It's when you have a cluster of signals. And you can see when this indicator goes up to +3 a bunch of times over the course of a couple weeks. That's when the real signal is triggered. Looking back historically, you can see a couple times where you've seen that. Number one, January, February of 2020, you had a cluster of Hindenburg Omen signals. Number two, July, August of 2019, which was a bit of a pullback, not too bad over the long term, but certainly came off. And then the third one was going into the 2018 low. This is September and October of 2018. If you look at those examples, you can see why people pay attention to this indicator. Now, having said that, there are plenty of times when you'll get a couple signals, but it won't really materialize. And maybe November of 2019 is an example of that. You saw it hit a couple times over the course of a week or two, but we really didn't pull back at all. So in the end, this is not something that tells me absolutely the market is definitely going down. It tells me the conditions are similar to previous market tops, similar to what we've seen with other breadth divergences, momentum divergences. It's something that raises the red flag and makes me want to focus a little more on the charts to see when we start to see some actual price weakness. So again, the Hindenburg Omen, named after the Hindenburg disaster, right? And what happens? It's meant to illustrate, to give you a picture in your head of what this might mean for stocks. It does generate a number of false signals. So again, I would encourage you, when you hear it talked about in the media, I don't think it means the world is necessarily ending. What it does is it tells you we're seeing conditions similar to previous tops, and for me, it tells me to think a little bit more about risk. Make sure that you have stops in place. Make sure you have a good sense of your own risk in your portfolio and your allocations, and focus on what you would need to see from the chart of the S&P, from individual stocks and bets to and positions to anticipate or to confirm when that indicator has played out and the market has indeed turned lower. So that is our segment, A Mindful Investor, focusing on the Hindenburg Omen. I hope this helps clarify some of it. And again, if you do !BI, you will see a series of indicators for the Hindenburg Omen on a couple different indexes that we track. We need to wrap the show. Go to the 3 and 3 charts in 3 minutes. Here we go. Chart number one is the chart of gold. We talked with Craig Johnson today about stocks, about oil prices, and about interest rates. We didn't talk about gold, and I think one of the interesting themes that came out of today is a bit of a spike in gold prices. Gold is what you think of as an inflation hedge. So when people get concerned about inflation, it tends to mean a rise in gold prices, because that tends to be a good place to ride things out. You've seen a bit of a bounce, and it's not just today. You've actually seen a bounce off of the 61.8% retracement level. That's 1675 to 1700 is a real clear support level, not just from the Fibonacci support, but also from the lows back here in April, May, June of 2020, also the highs from February and March of 2020. So there's this sort of parallel levels all around that same point. We're bouncing right about where I'd expect gold prices to bounce. The question here is this the beginning of something more meaningful? I would want to see a higher low of some sort, indicating accumulation in gold. At this point, it feels still like a bounce like we've seen previously during this long-term downtrend. I would caution that I think a break below 1675, taking us to a new swing low, certainly opens up the possibility of a deeper corrective move down to 1450. That would be the low from March, also the lows from late 2019, which feels like a long way away, and it certainly is, but possible. Chart number two is looking at the materials sector. What's interesting about materials is a sector that's continued to make new highs. Again, sort of the infrastructure play, higher rates, plays pretty well to this chart and the movement higher. What's interesting to me from a technical perspective, we broke above the January highs and now have retested it here this week from above. That's around $78 on the XLB, potentially rotating now further upwards. And so I think it'd be interesting to see if we're able to hold 78 and we continue that uptrend. I think the path of least resistance is up. Finally, I mentioned Lennar Homes, which is the first or the top mover in the scooter rankings today in the large cap universe. The ITB is a home builder ETF. It's a pretty good pure play on the home builder stocks, not just Lennar, but Toll Brothers and Pulte and D.R. Horton and all of those. But overall, setting up very well. The ITB making a new 52-week high again today, and the relative strength making a new swing high as well. All of that is setting up pretty well, not yet overbought, and I think there's certainly potential for further upside there. Folks, that is our show for today. Thank you so much for joining us every weekday after the close as we focus on the latest themes using StockCharts.com and the power of technical analysis. Special thank you to Craig Johnson from Piper Sandler joining us from Minneapolis, giving us his latest take on the market environment. As a reminder, Chart Madness is coming up this coming Monday. Go to StockCharts.com/Chart Madness. You can download your own bracket, make your own picks, see how your bracket lines up with our 4 experts as we debate the charts and focus on our potential winners this coming Monday, the 22nd. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.